Hello and welcome to today's corporate webinar with Smartkarma. I'm your host, Maliha Hadi. We have an exciting discussion planned for you today, so let's jump right in with an introduction to our panel. We're joined today by Geo Energy Resources management team. Geo Energy, for those unaware, is an SGX-listed major Indonesian coal producer. They have a successful track record spanning 15 years of operations across three key divisions: coal mining and production, road and jetty infrastructure, and marine logistics. We have with us today their CFO, Adam Dan, and COO, Philip Hendry. Joining us also is Smartkarma insight provider Samir Taneja. Samir is a commodities and equities focused buy-side analyst with over 18 years of experience investing in Asian markets. We'll start the webinar with the Geo Energy team walking us through a company presentation, after which they will engage in a fireside chat with Samir. We're also taking live Q&A for this webinar, so I would request our attendees to post their questions in the Q&A tab at the bottom of their screens. During the webinar, we'll also share some links on how you can connect with Geo Energy and read more research by Samir, so please do keep a lookout for messages in the chat box. Everyone, it is great to have you with us today. Let's dive right in with an introduction to the company. Adam, the floor is yours.
Thank you, Maliha. A very warm welcome and thank you to all attending this presentation today. So on this next slide, as you can see, a standard disclaimer. So on the next slide, we'll be touching on first an overview of Geo Energy. We are an established major energy group in Indonesia with a long and successful track record of around 20 years. Today, with a market cap of almost $1 billion, with free float over 40%. Consistently, the group has been delivering more than 100 million EBITDA per year. Now, we have a sizable reserve with a good mining life of more than 20 years. We have been investing in our MBG infrastructure, which Philip will share more later, and ramping up our TRA production in recent years, with a combined target of over $500 million per annum at full capacity. Based on this, we are still vastly undervalued. Now, a bit on the history of Geo Energy and our track record as we grew our assets portfolio over the years. You can see in this slide a timeline. Geo Energy was founded in 2008 and listed on the SGX main board in 2012, acquiring our first coal mine BEK in East Kalimantan. In 2014 and 2015, Geo Energy acquired our SGJ coal mine, commencing operations and sales in 2016. We further ramped up our reserves and production capabilities in 2017 through the acquisition of our TBR coal mine. So till today, we have sold almost 90 million tons of coal, generating cash profits of over $1.2 billion over the years. Over this period, we have also declared almost $300 million in dividend. And in 2023, we acquired our TRA coal mine, which significantly increased our coal reserves by over 4 times to over 300 million tons. This year, we did additional coal drilling, and you can see that our 2P reserves have increased further. So on the next slide, I'll just share with you our portfolio of high quality core assets. You can see in the snapshot in this geographical map, we are developing our MBJ infrastructure in Sumatra, which will better support our TRA coal mine that we acquired in 2023, as well as generate income from other road users. Now, we have a strong portfolio of cost-competitive coal assets and a track record of execution and delivery of over 10 million tons per annum, ramping up to 25 million tons per annum in the near future. So on the next slide. Okay, so on a robust financial profile, we achieved an average selling price of $44, around $44 last year. ICI4 actually achieved $60 as at 20th March 2026. Cargoes for 4-2 coal were reported, in fact, at higher than that for March and April. So it also shows an upward movement in the coming few weeks. In terms of sales volume, last year we set a production target and we achieved beyond that, and we nearly doubled our sales volume with a total production of 12.5 million tons in 2025. This boosted our revenue by 40% to over $500 million. This is despite the coal prices being a bit weak last year. In contrast, coal prices have now since increased by more than $20 since the last average price in the fourth quarter last year. So we also doubled our profit before taxes in 2025 to approximately $50 million compared to $25 million in 2024. Now, total net profit as well increased from $21.9 million to $27.5 million in 2025. Now, importantly, I think we didn't point out that 2025 total shareholder return, we achieved 46%. And in fact, in recent few months, it's gone up even further. Total shareholders return have been further increased to 76%. If you looked at it from the period of entering and 2nd January 2025 to now in March 2026. So for the next slide. So not just understanding our historicals, but also understanding the outlook ahead. So coal prices are strengthening, as everyone's aware, global tensions driving the energy market. We have seen coal prices have gone up steadily. As I mentioned earlier, in last year, fourth quarter, we are talking about close to $40. Now we have moved up to above $60. So this is an increase of over $13 per ton. And we have a target production that we have shared with the public of 11.5 million tons to 12.5 million tons. So if let's say you just look at a simple 12 million tons assumption, we are looking at an increase of more than $10 per ton. So there's over $100 more million in additional EBITDA, just purely from the recent coal price increase. Okay, on to the next slide. I'll now just pass to Philip to talk a little bit on the MBJ infrastructure. Thank you.
Thank you, Adam. Good morning, all participants. I'm Philip, the CEO of Geo Energy Group. Okay, so today I'm just gonna briefly touch about what we've done in terms of the MBJ road. Yeah. So a bit about this road. So we completed the acquisition of the TRA mine, okay, which the detail Adam just discussed earlier. We completed this acquisition, okay, back in the 2024. And then by fourth quarter, yeah, sometime in like, August, September, we started the embarking on developing the MBJ road. Now, why this MBJ road is important? Okay, essentially, this is where the key is. Yeah, this is the road to get all the coal mine, okay, and all the, it's not necessarily the coal, yeah, all the, minerals around the South Sumatra, okay, to be out, yeah, because currently the logistic, okay, in the South Sumatra is very limited. Okay, where else, like, there is like, one road currently that we are using, it's called the Atlas Road, okay, the length is about like 137 kilometers. And then the condition, for the lack of better word, is like, very challenging, yeah, for our truckings. Hence, we developed this road, okay, with the vision that, for every mines, okay, in the South Sumatra, we'll be able to use this road, okay, and then we developed this road with the mindset that this is going to be an international standard. And then this is not only for Geo, obviously Geo will take up about like, at least like 50% of it. Okay, but we are looking forward to actually like sharing this road, okay, to all the key miners, yeah, to all the big miners in South Sumatra, which will play a key part, yeah, in the, overall like, economy of Indonesia. Now, we started this road about like, fourth quarter in 2024, like I mentioned earlier. Okay, we set up like a very ambitious target. Okay, the overall target is about like 19 months. At that time, for the hauling road, okay, 19 months, okay, was almost unheard of in a sense that it's like one of the fastest timeline, yeah, in terms of like development of the hauling road in Indonesia. So we are very aggressive on it, okay, and then we engage the contractor, which is a CCCC and Norinco. So CCCC, a little bit of our contractor, they are like the biggest contractor in China. And they are partnering with Norinco, which is like, one of the largest SOE, South-owned enterprise in China. So between CCCC and Norinco, they work together, okay, to come up with all the capabilities, with all the engineering, the procurement, the EPC contract, okay, to build our road within the very challenging timeline. And proudly to say that as of today, okay, we are above 80% and we are well on progress to achieve our target by June or July this year, completion. So this road on the slide, it does say it's about like 150 million, okay, in terms of our budget. That is correct, okay, but what we actually spend right now is actually close to 200 million, yeah. And this is not due to like we are overrun, Okay, but this is actually what we analyze, and then we make a conscious decision because the road is 92 kilometer. There are like a certain area where it's actually it's a very swamp. It's a very deep swamp around like 24-meter depth. In terms of the swamp area, okay, so based on like, the original design, I mean, if we do the current road, which is fine, okay, but we anticipate there will be a settlement plus minus around like 1 meter deep for the next like 20 years. Okay, so you need to continuously like, do the settlement. So based on our careful discussion with the board and our internal management, we decide to actually upgrade. Okay, on like a certain kilometers, okay, there are certain point around like 4 or 5 kilometers. We decide to upgrade the road to actually do the slap-on pile, which is like the slap-on pile is like this big baton that you put in the middle of the swamp. Okay, and it's actually very, very challenging and very expensive. For 1 kilometer, the slap-on pile will cost us about like 10 million USD. Hence, around like 4 kilometer plus minus, we spend about like, 40 million plus just on a certain area of the road to make sure that the settlement now with the slap-on pile is going to be zero. Yeah, so just to make sure that the infrastructure will have the international standard, there's not going to be any settlement, okay, for like the next 20 or 30 years. Okay, we decided to actually increase our budget from 150 to 200 million. Okay, just to make sure that our road is really international quality. Yeah. And then the road can actually manage the capacity around 40 to 50 million ton. So what we're gonna do is for the first 2 years, okay, what we're gonna do is we're gonna do maybe like, plus minus 40 million ton. And after about like 2 years, okay, after the foundation is actually quite settled, what we do is we're going to do a chip seal, essentially like an asphalt, okay, additional about like 10 to 12 centimeter on the foundation. Okay, essentially after the chip seal, okay, the road is actually as good as like tall road. Yeah. So with that in mind, okay, after the chip seal, okay, we're gonna use about like, 2 times 70 to 2 times 90 ton truck. Okay, and then this is actually the key because the truck that we have currently, just a comparison with the Atlas road, okay, and all the road actually around the surrounding area, they actually use about like 30 tons. So our road is we're gonna start up with about like 2 times 70 tons, which is about like 140 tons truck. And then after the chip seal, we're gonna upgrade to about like 180 ton truck, which is 2 times 90 ton. And then the saving is substantial. Yeah, we got like a shorter distance. Our road is 92 kilometer compared to 137 kilometer. And then, the truck, instead of like 30 tons, all of a sudden you increase it by about like 7-fold. Yeah, you increase it to about like, between 140 to 160 ton truck. Okay, that itself, okay, will actually save, okay, will actually save our operational costs and everybody else that using the road. Yeah? It will save the operational cost of the surrounding mine, okay, to approximately $10, $11, $12, depending on your costing model. Yeah. So what we have, it's like we're developing this road, okay, with a very keen eye, where we can become like, the major player, okay, in the South Sumatra for the next like 15 to 20 years. Next slide. So this is just, a lot of the question that we got obviously from the analysts, what does the road look like? Because it's actually in the middle of the jungle, literally, for 92 kilometers. So we just actually include like, some of the pictures that we have. You can see that the pictures that we have, we built the bridges, okay, and then, for some of the public road, we actually built an underpass. And the underpass is actually a very important point here because as of January this year, the Indonesian government actually came up with a regulation that for the hauling road, for the key minerals, we cannot use a public road. Hence, it has to use a private road. So for example, like the road that we are using right now, which is called Atlas Road, there are some crossing to a public road, okay, which cause a lot of issue as far as using this road. Yeah? So currently, we actually obtain like a month-by-month approval from the local government to actually using the current road. But everybody in the area knows that this is not sustainable. Yeah, so there will be a very high demand. Well, it's not will be. There are very high demand where me personally, I've been getting a few phone calls from the surrounding mine, very interested on using our road. As a matter of fact, which is one of the questions, we have actually signed about 9 million tons commitment to use our road before the road even done. Yeah. So we have like 50 million ton. We intend to use 25 ourselves. So we have 25 for everybody else to use. So as of now, we already have about like 9 million tons like committed. Yeah, we have 16 million left. And then currently I'm also in discussion, okay, with one vendor. I mean, obviously for confidentiality, I cannot disclose. But the vendor want to sign for 15 million for 50 years. So right off the bat, okay, you do the math. I mean, essentially, we're gonna have like more than enough capacity, more than enough demand to utilize our road when the road is up and ready. Yeah. And then the other side of it, we also built the international jetty. You can actually see on the right side. Okay, our jetty will be able to handle the capacity up to about like 50 million ton. And this will be, we did this in the international standard, where we anticipate all the challenges, all the stockpile and everything, the quality of the coal. We reduce the double handling. Okay, so, cut the story short, both the road and the jetty will be the international standard upon completions. Next slide. I think, a little bit of that. I think that's pretty much it. Okay, so, we welcome all the questions. Okay, so yeah, we open this up for the Q&A sessions.
Right.
Great. Thank you very much for that, Philip, as well. So thank you for walking us through the slides. Let's further dive in by transitioning to the next part of our webinar, which is the fireside chat. So Samir, I'll hand this over to you now.
Right. Thanks, Malia. And thank you, Adam and Philip, for such a comprehensive and informative presentation. So I'll maybe just kick this off by asking a few questions. So I'd like to start with trying to understand more about the government caps that were put recently on coal production, where there were public reports suggesting that the intention was to cap coal production in Indonesia after 600 million tons from 790 million tons.
Right.
And you'd have the RKAB approvals by the Ministry of Energy and Mineral Resources. So now, in light of the current geopolitical developments and the world's requirement for energy demand, has there been any indication of revising these relaxations, and what sort of impact has it had on you? Have there been decisions made on your RKAB, etc.?
Thank you, Samir. I think that's actually a very good question. Okay, to answer your question is yes. So as you correctly pointed out, okay, the government in Indonesia is making a concerted effort to reduce the coal export. Yeah. So the coal export has reduced, as you correctly mentioned, from 800 ton to 700, and then this year for next in 2026, the target is about 600 million ton. Yeah. Now, the impact that we see from the 600 million ton is the demand continue to be strong, but the supply is actually, getting less, getting cut. So you will see, Samir, that, our ICI price, okay, our pricing index in ICI actually has increased very healthily in the past 2 months. Yeah. So I think that is important that we actually see the balance. Yeah. People see the coal is being cut, but for the miners here, maybe for the small miner, they will be impacted. Yeah. But from Geo side, we see this actually as an opportunity because number one, if you see our, I think it's on the next questions, our production continued to be very strong, 11.5 to 12.5 million, which is very comparable to last year. Yeah. Yet at the same time, the pricing is actually going up right now on the coal. Yeah. And even that, given the latest development, obviously, on the war in Iran, and then, that's really pushing up, the higher coal, the higher prices for the oil per barrel. Yeah, so the government recently has come up with the, with the news, with the announcement, but they will be advising, they will be adjusting, and advising a new quota for this year. Because the government also see an opportunity that with the coal prices continue to go up, it is actually a golden opportunity for Indonesia. As you know, Indonesia is is the largest coal producer in the world. So it's a golden opportunity for Indonesia to increase our quota again, while maintaining the coal prices at the current level. So we see this as the golden opportunity, not only for Geo, but all the coal miner in Indonesia as the opportunity to increase, number one, our productions, and number two, obviously, our profit margin, our cash profit, with the continuous increase of the coal prices.
Wow, that's a significant positive development, Philip. That's
Definitely.
if they are able to revise quotas upwards for you and the rest of the industry, that would of course help the current environment as well, where substitutes of energy are being blocked. So you also
Definitely.
guided your production would be 11.5 to 12.5 million tons, and there's an 80% completion of the MBJ. So could you maybe provide us a bit of detail on your ramp schedule to reach 25 million tons?
Definitely.
What would it look like in 27 and 28
No problem.
as the ramp is concerned?
So TRA is this, last year we produced around 2.5 million ton. A little bit of background. And then before when we acquired the mine, it's about 1.5. This year, we intend to produce about 5.5 million ton, again, subject to RKAB, although we are quite confident this will pass. As you can see, from 2.5 to 5.5 million ton this year, we are essentially increasing our capacity by 100%, doubling it. And then what we intend to do is we intend to actually use the current road around maybe about 3 million ton. And then once the road is done, MBJ, which is by July, after the commissioning, we intend to apply maybe about 2.5 million ton this year using our new road, MBJ, until the end of December. So this year, we intend to do 5.5 in 2026. And 2027, our goal is to double it again, Samir. Yeah? It's to double it again to maybe about 10 to 11 million ton. Yeah. In 2028, our goal is to at least increase it by about at least 50% to 80%. So from 10 to 11 in 2027, our goal is we are looking around 15 to 18 million ton in 2028. And then, needless to say, in 2029, we intend to achieve a full capacity, full production at 25 million ton.
Right.
Now, this is not something that, I just said it. This is something that we've been planning. It's been discussed, debated internally. Yeah, and every effort is currently being made internally to achieve this goal. Yeah.
Understood.
Yeah, this is the minimum, Samir. Our goal is actually to at least achieve this and exceed this production target.
Understood. And so that would mean that there'll be some sort of cadence of reduction from the other two mines, the TBR and the SDJ mines, right? So if we were to add them in the grand scheme of things, what would the 2027 and the 28 look like? I guess the implication is that the production comes down to about 6 million tons from SDJ and TBR in 2026. but then in 2027 and 28, is there a cadence of decline from them even further?
Yeah, SDJ will be done this year. Okay, will be mined out this year. Okay, and then for TBR, feel free to correct me, Adam. Yeah, but for TBR next year, we are looking to mine out. We are looking to mine plus minus about like 3 million tons. Yeah. Okay, so for next year, we are looking about like, for Geo to produce approximately between 13 to 15 million ton conservative. Okay, and it's our anticipation, depending on how we do the mining plan. Okay, but we intend to mine out TBR maybe in 2028. Yeah. Adam, you have any comment on it, Adam?
Yeah. No, I think your timeline is right in the sense that, of course, SDJ is slowly mined out. We still would mine small volumes, but I think largely this year will be the biggest volumes for SDJ. For TBR, we are doing the joint boundary mining, as we have shared before in a job report as well. There will still be a relatively strong volumes next year, 2027, and 2028 onwards, it will start coming down as well, as we mine out both of these SDJ and TBR mines.
Understood.
Yeah,
that's really clear. Thank you so much for that. On the capex allocation, I know you mentioned there's been a slight increase in the capex allocation, owing to the fact that you want to fortify your infrastructure asset and make it world class. So now it's 200 million of capex allocation. So to date, how much has been spent in this 80% completion? And if you could sort of quantify on the timing front how things would sort of pan out, when can we expect third-party haulage, etc., to start?
Yeah, thank you, Samir. So maybe this one I'll take this question. As you rightly pointed out, in terms of the EPC contract value, it has gone up as what Philip has shared in terms of because of the slap on power and the quality work that we want to achieve. So capex is closer to 190 to 200 million for this EPC contract. We have paid upfront about close to $40 to $50 million. It's important to note that for this EPC contract, there is a mechanism with the contractors such that there is a deferred payment, and it's also backed by Sinosure. So we do not need to make payments upfront. It will be paid out by the asset itself. So the asset will make cash flow in the future, and using the cash flow from the assets, we would be able to pay off this deferred payment scheme over the next 2 years. And that's the structure. So when you mention about capex allocation, I just want to clarify that what we discussed is on the EPC contract itself. There are also, of course, other capex that we have spent in terms of acquiring the necessary land and also opening up the mining pit for our TRA mine.
Understood. Oh, okay. So that's pretty clear. As in when the assets utilized, your capex gets paid through the deferred payment.
Yes,
right. All right, great. And in terms of when third-party haulage, etc., would start, and if you could provide some revenue and cost assumptions associated with that for us to just sort of understand. I know you mentioned that will help bring costs down effectively by $10 per ton. And if I do the math, that comes to a very, very attractive rate of return. But if you could provide some sort of breakdown as to how maybe third-party haulage would happen, that would be great.
Yeah, sure. So I think in terms of the third-party haulage, we are looking at, Philip, correct me if I'm wrong, but we are going to start mostly next year for the third-party hauling. Of course, first priority is always to our own mine, which is the TRA mine, which we will intend to do so starting from second half of this year. In terms of understanding a little bit of the cost savings, as you mentioned earlier, the primary savings is in terms of the efficiency of the road. It allows, as what Philip shared earlier as well, 2 times 70 tons up to 2 times 90 tons trucks, which is a lot more efficient than the existing infrastructure. So with that, hauling costs will come down drastically by about close to $7 per ton. In terms of the infrastructure itself, we do save money as well, because right now if you use third-party infrastructure, which is the current Atlas road, we actually have to pay them a toll fee, right? But now instead of paying a third party the toll fee, we are paying ourselves. So that is where there is also a significant savings within the group. So that's kept within the group. And I think that in totality adds up together to over $10 per ton. In terms of the profile that we earn from third-party road users, it depends on a little bit on coal prices. Without going into specific numbers because it's sensitive pricing information, but we do expect a net margin of around maybe $8 per ton for this MBJ for third-party users. And if you can multiply by the capacity, it's quite easy to forecast in terms of the cash flow that you can bring to Geo as a group.
Okay, great. No, that's really helpful.
Mm.
Yeah. And this year, I guess now in your press release, you mentioned that on an indicative, let's say USD $60 per ton ICI4 price, you estimate 170 to 200 million of EBITDA for 2026. And if I work backwards, it builds out a cost per ton of $44 to $46 per ton. So, if you could just sort of break down these costs for us into royalty, mining, processing, etc., that would be great.
Sure. Of course, I can't go into too detailed breakdown.
Yeah, just a short, just a few buckets, and that would be great.
Yeah. But of course, I think this is where we're coming from. Is this 170 to 200 million EBITDA that we mentioned is purely on the coal mining segment. Just to clarify, because we also have the MBJ infrastructure, we will also have the barging business that we mentioned earlier, we acquired earlier this year. So these two segments will also have the contributions to our group's profitability for 2026. But the bulk of it, because the infrastructure is coming up only in the second half of the year, the bulk of the profitability this year would come from the coal mining segment, as you rightly pointed out. So we earlier had an announcement that we mentioned, like you said, 170 to 200 million EBITDA. That effectively implies average cost close to maybe low 40s. So you mentioned the ICI4 price. Of course, it has gone up to 60 plus, but I think in this assumption we have conservatively used a slightly lower average selling price because it's averaged out for the year. But in general, we're talking about $40. This is actually quite close to our costing for TRA and for TBR last year. If you take into account, of course, royalties is the biggest portion in terms of increase. In terms of the biggest increase is the royalties, because if coal prices gone up, you're actually paying more royalties. It's about maybe close to $5 per ton. Coal mining and overburden removal would be the biggest portion in excess of over $15 per ton. And then there'll be other logistics fee that would add up to totality to about close to $40 per ton. This also includes the transshipment fees as well. Yeah.
Got it. Okay. No, this is really clear. Thank you so much. And now you mentioned that also you have like a 51% strategic acquisition stake in PT Trans Maritima Pratma and the Bahari Segara Maritime. So if you could just touch upon what you think these bring to the table for you, that would be great.
Sure. So I think this is basically, as you know, we have a steady flow of coal, right? Because we're the coal producer itself. We are not buying the barging business to do majority third-party coal. We're doing it majority for our own coal production. So strategically, the key is really securing the shipping capacity, securing the flow, so that make sure that there is no delay. Damages can cost a lot to the group if the vessels are not available or in the poor condition when your coal is already ready. So I think that is the largest strategic importance of acquiring our own seaborne logistics operations. In terms of cost, I think it will be pretty much market rate. We are not going to pay lower or higher. It's quite standard market rates. But instead of letting a third party make a margin, we're actually keeping it within the group. I think that is, in terms of economics wise, it's still margin and cash flow that we would save because it's kept within the group. But ultimately, it's still the bigger impact that is probably not as seen as easily is really the strategic importance to secure the shipping.
Understood. Okay.
Yes.
Sounds good. All right. On your balance sheet now, it's obviously going to be much stronger given the coal prices now and the amount of cash flow coming in. You do have a $250 million facility which carries approximately 8% rate on it. So, can you give us any maturities and any hedging happening on the book? And is it likely that now with increased cash flow, you'd sort of pare down debt, and we could get interest cost savings in the future?
Sure. So actually, just to give some clarity, we actually secured a upsized $275 million US dollars facilities from Bank Mandiri. It refinanced the old facility, which is about 250 million at the start, to fund basically our capex and our operation requirements to ramp up TRA mine, and also to fund the acquisition of the barging business as well. So important to note is that this new facility has a significant interest saving. So previously, when we first did the first facility, it was about 8% rate, like you rightly mentioned now. But the latest interest rates that for the newest facility is about 6.7%. So there is a significant interest savings in terms of our cost of capital. We do not need hedging in place. Majority of the loan will be in US dollars. This matches the majority of our sales, which is also in US dollars. So there is some natural hedging. Of course, there is a small portion in IDR for working capital purposes that also matches, the domestic sales that we collect, which is in IDR as well. So there is no specific hedging in place.
Great. Understood. Okay. And so I guess now with the extremely fortified balance sheet, very strong, I'm guessing that you guys can have a pretty, is it possible that you can increase your payout ratio or dividend policy going forward to 30%, or should investors still expect it to remain the same?
Yeah, I think to answer your question, I think generally the investors should still expect the same in the sense that our dividend policy, we do want to maintain as 30% of our group's profits. But of course, if the group's profits increase due to, as you said, the coal prices and everything, we would be willing to consider potentially increasing a little bit. As we have seen in 2021, 2022, when coal prices were very high, we actually paid as high as 40+% payout ratio. But our dividend policy will remain unchanged in the sense that it's 30%. But we're open to having one-off special dividends, etc. So that's something that we'll see according to the performance of the group.
Right. Okay.
And I'd like to comment on that, Samir, if I may.
Sure.
Yes.
So I think, obviously, like Adam mentioned, dividend is good. Yeah. I mean, we continue maintaining the dividend policy. Yeah. But on our side, we are trying to balance between the spending for dividend and then reinvestment back to the business. Yeah.
Right.
Yeah.
So what I like to emphasize to all of our investor and shareholders, which I always do, by the way, is don't only look at the dividend, look at our share price. Yeah. Our share price has almost doubled in the past 12 months, 15 months. Yeah. And our share price right now actually has grown like a very, very healthy increase. I think Adam can give you the percentages. Yeah, and our share price, I'm not going to be very surprised. I mean, I'll be very careful in saying this. It's not insider trading. But I said our share price is definitely trending. I'm not going to be surprised if our share price increasing by double-digit growth in the next 6 to 12 months again. Yeah.
Right.
So for me, it's obviously, we hold the market. Yeah, people are holding the dividend. Okay, those are good, obviously. But at the same time, you need to look at the fundamental, okay, that, we are trying as a responsible company, trying to balance between the payout for dividend and then the reinvestment for business. And then, so, what I like to implore to all the shareholders is don't only look at the dividend, look at how well we do in our share price. Okay, and that is the testament on how well we actually allocate the cash that we have to grow our business.
Agreed.
Yeah.
Got it. Okay. Understood. I mean, the reason I guess the people from the floor are asking about dividend is that, coal is obviously a very cyclical commodity.
Right.
We have seen higher prices in 2022, 2021, and then, they came crashing down. So with a sort of dividend policy, what would happen is shareholders would see a portion of, the upcycle in the coal price as well,
Definitely.
Especially the ones who are long-term in nature.
Definitely.
I'm just taking a few questions from the floor. There is a question on your third-party usage of coal. I guess there has been, you guys have actually elaborated on it. I know you had mentioned that you have 9 million tons committed and then another 15 million tons that can potentially be committed. I guess one of the potential investors is asking for EBITDA and PAT assumptions, but I'm guessing you've mentioned that you get an $8 saving. So, well, I guess that's pretty clear. And the other question is on the geographical spread. So a lot of people want to know, like, I guess, where geographically your coal goes. And, with the closure of the Straits of Hormuz, can we expect to see more tonnage being diverted to countries like Vietnam, the Philippines?
Either you want me?
Yeah, sure. You can start. I add on to you.
Okay, sure. So the majority of our coal right now, okay, Samir, is actually going to China.
China.
Yeah.
Yes.
Okay. And then obviously, there are some, I think, going to India. Okay. We don't export to Vietnam and Philippines, at least in a major capacity right now. Okay. But I can tell you that as far as like the increase in coal demand in those countries, yes, we do notice that. And then as a matter of fact, on our marketing side, okay, we are making like, a concerted effort to go into like the Philippine market in the near future.
Right.
Because Samir, actually the Philippine market in terms of the pricing, they are actually very good. Yeah.
Right.
So we are making a concerted effort to actually going into those locations. But I like to emphasize that currently, in terms of the demand in China, is actually very strong, Samir. Yeah. Okay. With this blockage, in the Hormuz Strait, currently the premium for our coal is actually very, very healthy. You're talking about like, even like +6, +7, +8 premium about the price. Okay. So yes, we intend to like, definitely we see like, Philippines, okay, particularly as like one area that we will expand. Okay. And then we do see like a coal demand, like a very healthy coal demand coming up from other regions. But, from at this present moment, okay, we're continuously focusing on China, and then the coal demand in China has been very healthy, including now.
Yeah, and to add on a little bit to what Philip shared, I think we also see other countries, including Japan, because of their LNG being affected, they are also restarting coal-fired power plants. And even though we don't sell a lot, big quantity to Vietnam and Philippines, but coal is a commodity, so definitely this has been driving up coal prices throughout the whole region. So that's something that definitely we want to be well placed to capture this increase in coal prices.
Okay. Oh, just on that, you have an offtake agreement with one of your shareholders, I guess, right? So, and that's a pretty chunky offtake agreement. It's pretty huge in size. So, does that also, I guess, impact your decision making on where you need to, where you ship the coal? Because there is a huge offtake that will happen through them.
No, so actually we although we have offtake agreement, but it's based on market index prices.
Okay.
So it does not necessarily have a control over like where you want to sell to, but China generally pays the best prices and highest demand from China. So naturally that's where most of our coal go to. Yeah.
Understood. Okay. Well, that's clear. Okay. All right. We're just waiting on some more questions from the floor.
Yeah, so as you mentioned at the top, you can now send your questions to the team as well. They will be happy to address them. So we actually did address a few questions, I think, with respect to dividend policy and with respect to the Strait of Hormuz production just now. I think we also have one other question just now from another attendee. Their question is, what are resources and reserves for TRA mine, and what is the life of mine assuming 25 million TPA?
Right. The resource and reserve for TRA mine on the latest JORC that we have, it's actually around like 317 million ton. Yeah, so above 300 million ton. Now, obviously, as we increase more drilling, okay, the reserve will go up. Okay, we anticipate even up to 375 million ton annual total reserve. Obviously, assuming that we mine like 25 million ton, okay, in our book, we have every intention, assuming continues 25, okay, but in our book, we target about the life of mine plus minus about 15 years. Yeah, but you know very well, I mean, something it's always up and down. So realistically, we could be looking about the life of mine between like 15 to 18 years or even like 20 years. Okay, just depending on how many drilling that we want to go and what kind of SR, yeah, that we are trying to maintain.
Got it. That's clear. Thank you. So I believe that's all we have for today for our audience. Thank you, everyone, in our panelists who attended for this fascinating discussion. I think we learned quite a bit about geoenergy, and the fireside chat was especially invigorating because we were really able to dive deep into that. I really appreciate you guys, elaborating on that. And for our attendees, thank you for joining the session live and bringing your questions to the table. In case you have any more questions that you would like the team to answer, please do reach out to them via the links shared. And we will be sharing this recording as well, just so you can take a look in case there's anything that you've missed. So with that, I'd like to wrap up today's webinar. Thank you and have a great weekend.
Thank you. Yeah,
Thanks,
bye.
Adam. Thanks, Philip.
Thank you.
Yeah, thank you.
Thank you so much.
everyone.
Bye-bye.
Bye-bye.